Back, you're watching The Money Show on ET Now. Well, we've been doing a deep dive in ESG investing, and here's a simple way that you can invest in ESG by investing in ESG funds. One such fund is the Kotak ESG Opportunities Fund. We have with us Harsha Upadhyaya of Kotak Mutual Fund, who manages this fund. Harsha, thank you so much for joining us today on the show. So to start with, Harsha, tell us a bit about your fund. Yes, ESG are the parameters you look at, but they seem to be really strict and stringent. So how do you search for opportunities then?
Yes, this is a fund which looks at non-financial parameters along with financial parameters. Whenever you do a regular investing, you analyze companies from a fundamental perspective. You assess financial parameters and take a call whether it is worth investing at a particular point of time based on the valuations, relative growth opportunities, etc. In case of an ESG fund, while you do all of this, you also do additionally in terms of assessment, you will look at what are the different criteria that will impact environment, social factors, and governance factors. And so to that extent, along with financial parameters, you also focus on non-financial parameters and its impact on overall society, environment, and governance. So to that extent, the focus would be on the companies which make money, not only which make money, but also how they make their money in the overall context.
You know, Harsha, we were looking at some data that how the Nifty 100 ESG index has actually managed to outperform the Nifty 50 and the Nifty 100 as well. I would, believe that your fund may have as well done the same in the last 1 year, in the last 3 years, in the last 5 years as well. What do you think is the rationale behind this trend, and do you see this trend continuing going forward as well, where ESG compliant funds, stocks would perhaps do better than your traditional non-ESG compliant funds?
This is somewhat exhibited across markets, wherein ESG focused investments have done slightly better than the mainline diversified baskets. The reasons could be at an initial stage itself, these are curated for potential ESG risks. I'm not saying that you will be able to contain all of those risks, but at least there is a first level of assessment that has already been done. And usually these are the companies which are better in terms of managing those ESG risks. And time and again, we have seen that in case of a stock volatility or market volatility, you will see the companies which have higher governance issues, higher issues related to environment standards, or the companies which have adverse impact on society, etc., usually tend to get derated much faster and on a sustainable basis. So to that extent, those risks are already kind of analyzed in the ESG basket, and this basket is supposed to have lesser risk on those three factors as compared to the rest of the market. Maybe that's one of the reasons why you get a better sustainable performance from this particular basket when you compare it to the rest of the market.
I have to ask you to, grade the risk profile perhaps of your ESG fund versus maybe a large cap fund or a mid cap fund. Would you say that relatively you would call the ESG Opportunities Fund a little less risky compared to the other equity funds?
In fact, at Kotak Mutual Fund, we signed up for UNPRI, which is a voluntary network of institutional investors who follow principles of responsible investing under the guidelines of United Nations way back in 2018. So to that extent, our research has already been integrated with the ESG process. The entire investment process also is integrated with the ESG process. So to that extent, even other funds that we manage today, which are not called ESG funds, but we have various other focus areas, are also in a way following the ESG process, because that's internal to Kotak AMC now, being part of the overall UNPRI guidelines. So I wouldn't say that some of our other funds are more risky as compared to ESG fund. But in case of an ESG fund, there is a definite mandate that comes from the regulator. As far as SEBI is concerned, one needs to have at least 80% of the investments in the ESG theme. So that's the differentiation between a regular fund and an ESG fund. but there is no bar on regular fund holding more than 80% of its investments in ESG theme. So most of our funds are well covered on ESG principles. And if you look at our portfolios in the past, some of the big governance related issues that we saw in the market, which resulted in significant falls in various stocks, none of those stocks were a part of our portfolio. And similarly, if you look at environment and social issues, we have been able to avoid one or two issues that have come up in the Indian context across our portfolios. So I wouldn't say that ESG fund is the only one which curates all of this risk. But yes, this is something that anyways will be done in an ESG fund. Whereas in other funds, there will be probably a little more tilt towards financial parameters rather than ESG factors.
What are the challenges, Harsha, you face when you have to select companies for the fund? Do you find yourself, really having to struggle looking for opportunities because you're obviously culling out a big section of companies and stocks that you can actually put into this fund? Do you think that's a challenge in India because compliance is still a little on the down low compared to maybe US or European markets?
First of all, the ESG standards across geographies, across markets are not uniform. So to that extent, there is a bit of a confusion that's going to be there when you compare funds across regions. But as far as India is concerned and as far as we are concerned, our ESG fund is based on an exclusion principle. We are excluding 4 industry segments from our ESG fund. One, tobacco. Secondly, liquor. Manufacturing of controversial weapons, and finally, the gambling operations. So these are the 4 industry segments that we have decided to exclude from our ESG fund. And this is also being done by the benchmark provider. They have also excluded these 4 segments. So apart from this, all other stocks are eligible for ESG investments based on their ESG scores and their financial attractiveness. So overall, yes, there is a constraint in terms of the investment universe because you are excluding some parts of the economy. But at this point of time, this part is not very large in terms of listed stocks. So that's not really seen as a constraint from our side at this point of time.
Okay, that's good to know. No constraints right now in terms of picking out corporates that are compliant with ESG. So Harsha, if we have to look at suitability of ESG investing as well for retail investors, you know what we say in personal finance parlance, right? That when you invest in mutual funds, you should have a certain goal in your mind. Does the investor profile of someone who wants to invest in ESG differ from any other equity mutual funds, apart from the fact that of course they want to choose companies that meet their ethical standards on climate change and various other factors?
No, not at all. I think most of the financial parameters in terms of suitability would be similar in case of ESG funds as well. The only other factor is here there is potentially less risk in terms of overall portfolio. So to that extent, even first-time investors can come into ESG funds. And like all other equity funds, it will carry the market risk or the equity risk, which is the volatility that is inherent to equity markets. But beyond that, I think ESG funds will also provide you a lot more downside cushion. As I explained earlier, some of the red flags that you will see on E, S, and G factors may have already been known. And so to that extent, the portfolio may avoid some of those pitfalls. So for an investor, I think it's an easy to understand product. It's similar to all other diversified funds. In fact, there are no restrictions on the market cap allocation, etc. It can move across market capitalization. It can choose stocks from any sector except the 4 that I mentioned earlier. Overall, it's a well diversified portfolio with potentially lesser risk as compared to a normal diversified.
Okay, all right. Well, Harsha, we leave it at that. Thank you so much for joining us today on The Money Show.
Thank you. It was my pleasure.